I'm reporting to you today from my basement, where I'm currently sheltering in place trying to figure out whether the housing market apocalypse is about to start. Rates are up almost 2% since December. Inflation, as we know, is sky high. House prices, those have jumped something like 30% over the last 2 years. With everything leading up to this moment, as we look forward, are we going to see a crisis, a calamity, a collapse, or are we headed for something better characterized as a correction to the overall balance of our economy? In this video, I'm going to answer this question in a way that will probably surprise you. But more importantly, I'm going to share advice for what you should do no matter what happens in the future. And this advice has something in common with the UFC. But before we really have any chance of understanding the possibilities that the future holds, let's talk about how we got here. Why is it that mortgage rates went from the low threes in December of last year to about 5% here at the end of March? The short answer: the Federal Reserve. You see, despite the complexity of the commentary that you'll see on what the Fed does, from various talking heads on TV to articles that you read, and even from the Fed statements themselves, I would argue that much of the time, the perceived complexity of their operations is a bit of a veil. In reality, it is useful to point out that the Fed really only has a couple simple tools for influencing our economy. On one side, you've got the unsalted sweet cream butter of loose monetary policy. In a troubled economy, the Fed is going to liberally spread this butter into all the nooks and crannies to grease the engine of our economy in various ways. And the other tool? Well, it's a hammer, which is used to smash the inflation that inevitably results from getting too much butter all over the place. And this is especially true when the Fed seemingly takes its application instructions from what they see on the back of a shampoo bottle. Rinse and repeat. Rinse and repeat. I know that at this stage of the video, I am making increasingly ridiculous metaphors here, and I'm not sure it even makes sense to me, but hopefully you kind of catch my drift. Now, if we go back to the early days of the COVID pandemic between, say, February and March 2020, before the Fed squeezed any extra butter from the toothpaste tube on top of what was already there, mortgage rates actually dropped on their own. Why? This is due to a phenomenon referred to as the flight to quality. What this refers to is the phenomenon of large institutional investors and banks taking money out of riskier stocks and putting them into the relative safety and security of bonds, including mortgage bonds. Now, what triggers this is typically uncertainty and fear. And of course, the COVID pandemic certainly fits the definition of uncertainty and fear. Now, like any asset, the more demand you have for it, the higher the price of that asset is going to go. So as more money flowed so quickly into mortgage bonds, fueled by this fear and uncertainty, the price of those bonds increased. Now, when mortgage bond prices go up, the rates that the consumer pays on the other end of that financial instrument, that goes down. So this was good for mortgage rates. However, something very strange happened. This initial flight to quality in the markets was actually relatively short-lived. What apparently happened is something like a critical mass of bond investors felt that there were even safer havens for their dollars. After all, this looming pandemic was ultra scary and pretty much totally unprecedented. So basically what happened, these people with their money that had driven up the prices on bonds, they kind of took their toys and went home. And this caused bond prices to fall. Now, the result of this I actually saw in real time. I was coming into the office one day, it was probably late February or early March, and I was expecting to lock in a few different refinances for various clients that were trying to jump on this little refi boom we had going. Now, unfortunately, what I saw as I started pricing things out for people is that the rates from yesterday, which were in the low threes, jumped up into the fours like overnight. My first thought that this was a little refi boom, and it was a lot like a lot of other refi booms I saw. I've been doing this since about 2005, and there were many, many times where there's a kind of brief window that opened and then closed. Now, one thing that's important to keep in mind is before the pandemic, mortgage rates were actually already like really, really low. So it actually made sense to me that this opening, this refi boom, was a blip. That was until the Federal Reserve announced it was going to butter up the bond market by taking over for the guys that left it. What they planned to do was to buy up tons and tons of mortgage bonds every single day. And in fact, they bought so many bonds that bond prices got bid up even higher than they were before. And this is what caused the rates to fall to the truly historic low levels that we saw. Now, I remember thinking at the time, do we really need this? I get it, it's a scary time, But every time I heard someone refer to this large, sustained dump of Fed dollars in the mortgage bond market as being about stabilizing the market, I wondered whether this qualified as stable. To me, it seemed a bit like chasing Adderall with like some more Adderall. It was obviously good for me given the business that I'm in. It was obviously very good for many of my clients who got to reduce their rates. But what were the chances that bringing 30-year fixed rates into the twos and keeping them there for a very long period of time, what were the chances that that might lead to some sort of unintended consequences? I'd argue that the biggest unintended consequence was reducing the cost of debt for consumers. And this is an integral part of why house prices got so high. So after nearly 2 years with their buttery thumb on the scale of the bond market, growing concerns about inflation caused the Fed to announce that they would actually taper this program off in a stair-step fashion. In fact, what they ended up doing was accelerating their timetable, ostensibly due to high inflation that, despite the Fed's earlier comments, didn't appear to be transitory or based on some sort of acute short-lived supply chain problems. And as you can see from the rate chart, the rates rose in lockstep along with the stair-step drop-off pattern of the Fed tapering. So here at the beginning of April, rates have shot up as the butter injections effectively dropped to zero.
Mark, why is there butter all over the floor?
Now, normally I am somewhat loath to make what I see as kind of cheap claims over something that could easily be kind of a correlation issue versus causation, but the causal link between bond prices and Fed intervention with their initial rollout of the bond purchase program, what it does to me is it makes the inverse relationship both logical in principle and clearly observable. With all that said and done, it's likely they accelerated the tapering so they could come out swinging ASAP with the anti-inflation hammer of higher Fed rates. By the way, just because the Fed raises their Fed rates, that does not have a direct impact on mortgage rates. The big thing that they did to influence mortgage rates is the program that they tapered off from. Now, it turns out that this is no ordinary Fed hammer that they're bringing out. Now, what they're going to do is bring out the sledge because their plan is to raise rates faster than what we've seen since 1994, back when the bathtub oracle Alan Greenspan was running the show. But now that we kind of know how we got here, let's get back to the critical question of this video. Will the shift from butter to the hammer be the latest domino to fall toward crisis? And I'll tell you, for the clients that I've pre-approved over the past couple years, many of whom are still looking, some of my folks have been looking for well over a year now, they've been living through a crisis already. And if I'm being perfectly honest here, the focus on crisis is being defined as a big drop in housing prices. To be perfectly honest, it's kind of offensive to me. You see, it's not normal to have to offer $50,000 above a listing price on the day a property hits the market just to earn a privileged position in a further bidding war. It's not normal to give up financing contingencies, inspection contingencies, appraisal contingencies, and all the normal contractual protections that keep the balance of power reasonable between buyer and seller. It's not normal. It is the crisis. In my opinion, the rates never needed to go into the twos for a 30-year fixed mortgage for the stability of the economy. What we've experienced in the real estate market over the past 2 years is nothing remotely resembling stable. It's not normal. It is the crisis. Now, I'm going to leave all of the predictions on exactly what comes next to the folks that feel confident that they can apply some sort of like inductive reasoning to past patterns and graphs. The idea that that's going to lead them anywhere close to precisely what happens tomorrow, I think is foolish. But is it likely we're due for a correction? I sure as hell hope so. Now, one thing is for sure. At the present time, given that rates have increased so rapidly, home prices, as far as I can tell, haven't really budged yet. What we're very likely to see can best be expressed by thinking about maybe one person out there that's looking to buy a house. Let's get away from the graphs. If you've got this one person out there looking for a house and they have been maybe pre-approved up to the absolute limit of what they can be approved for, let's say it's $300,000. Well, when the rates go up 2%, they are no longer going to be approved for $300,000. Will higher rates reduce demand overall? They are certainly at least going to push many people down into lower price points. But regardless of what happens going forward, I strongly encourage everyone to focus not necessarily on the greater US economy, but on their own household economies. As the referees say in the UFC, to the fighters before a match, Protect yourself at all times. Spend wisely. Pay yourself first and save something out of every dollar you earn. Whether you work for yourself or for a company, do your best work. If you do want to buy a home, I think that's great. But with prices as high as they are now, your best hedge against the risk of buying high and selling low, well, it's not to sell low. Hold the property. Enjoy the property with your family. Improve it if you can. Rates right now are still very low compared to many other periods across history. And if you do intend on delaying this process, which again, I think is a totally reasonable conclusion to come to, just one thing to keep in mind is that if there is a drop in house prices overall, and if rates are higher, you could end up in a situation where yes, you're paying less in terms of the purchase price for a property, but your actual cost of ownership could be the same, it could be more. It's going to be different depending on where those interest rates actually land. So if you are looking to buy, or if you just want some advice, you want to talk strategy, I'd love to hear from you. Give me a call or shoot me a text at the number below anytime. I can help you with your mortgage no matter where you are in the country because Paramount Bank is licensed to lend in all 50 states. Thank you so much for watching. I hope to talk to you again soon.